You brought it up yesterday at our mastermind here, and you said Trump didn't pay taxes. So did Trump break the law?
No, he didn't.
We are live in Kansas City, Missouri for the fourth mastermind that we've ever done. And we've had Mark for his second time. You fucking killed it yesterday. Everybody loves talking taxes. Especially the way you put it with like all these characters of like Mr. Ed or something like that. But I want to just get into it. I wrote a list of questions that we want to go through. First of all, if you guys don't know, Mark is my personal CPA, a really good friend of mine, and probably the best accountant that I have ever met, tried, true, and tested. And I want to preface this entire podcast with how I met Mark, which I've told everybody except for you, the listening audience right now. So I was audited in 2008 for my 2007 taxes. We had a 1099 that I had received that was not filed with the accountant that I currently have, meaning that I probably lost the 1099 and she filed my taxes. Well, you might think, hey, Troy, well, you're an idiot. Well, I didn't think so, but I did ask the question to the next three accountants because after dealing with the IRS, having to pay them a little bit of money, I knew I never wanted to go through that again. So I got into solving the problem, and I called three different accountants that were recommended to me that I Googled, whatever I did to find them. Mark was one of them, but I asked every person the same question. I said, this is what happened to me. How would you stop this from happening to me again? And nobody gave me a good answer, but Mark says, well, it's simple. Before we file your taxes, we check the IRS's website to say, what do they have? And if it doesn't match what you gave me, we don't file because that'll trigger an audit. And I was like, mic drop. So Mark, I appreciate you saving my ass for years and years and years and keeping me out of trouble and making sure stuff's done correctly. And every time we've done a podcast, it has gone off. So I know you mentioned that the other day, right? Would you say people come out of you to blue all the time now?
Yeah, it's really interesting. I just say, hey, I saw you on this podcast. Hey, I saw you on this. Hey, you were pretty cool on this. And I was like, I'm just saying, oh, that's great. That's great.
So let's get into it. Okay, first question is, what are the tax advantages of investing in real estate?
Well, there's so many, and depending on what you're trying to do, there could be tax deferred exchanges, there could be cost segregation studies. You look at depreciation when you're planning with rehab and everything. There's just so many different ones that you could take advantage of with the law, the existing law, and with potential laws coming up.
All right, so let's dive in that a little deeper. What's a tax deferred exchange?
So a tax-deferred exchange is it's under the tax code called 1031 exchange. And basically what it is the law allows you to exchange real estate, like-kind property for like-kind property, and basically defer the gain into the next property and not pay the tax currently.
Okay.
And there are conditions. You've got to, purchase the property that you're going to buy. You got to identify it first in 45 days, and then you got to close on it 180 days later.
So layman's terms for me would be like, hey, listen, guys, if you bought a property, you had a large gain on that. So you bought it for $100,000. You went to go sell it. It's worth $300,000. You have a $200,000 gain. What am I going to pay on taxes normally on that?
Right. In a 1031 exchange, you won't currently pay taxes.
But right now, if I didn't do a 1031 exchange.
Oh, it could be depending on what bracket and also states.
So I'm in a high bracket. What would I pay?
Yeah. So let's say 23.8% on the federal.
So if on $200,000, I'm going to pay about $45,000 in taxes. And through the 1031 exchange, I wouldn't have to pay any money.
Currently, yes.
Currently. Okay.
Yes. Because all you're doing, you're essentially kicking the can down the road.
I love kicking the can.
Yes.
Okay. How can depreciation be used as a tax strategy in real estate investing? And can you define what depreciation is? Meaning like...
Yes. Yeah, so depreciation is essentially a paper deduction. The government has said, look, we understand that these assets over time will wear down and break down. And so we're essentially giving you the ability to write off or lower the cost of these things over time by taking a paper deduction on your tax return.
Okay.
That's depreciation.
So the thing that makes the most sense to me is you have profit and you have losses. So when he says deduction, in my head, I hear loss.
Yeah,
But it's a paper loss. That's why you use
right. I say paper deduction because it's really, you've paid for the item. Obviously you paid cash for the item, or you borrowed money to buy the item, but you're not on the tax return. You're literally taking a deduction that's a paper deduction, taking it, let's say an asset that can depreciate it over 27 and a half years, a family unit. Then you would just take that amount, that cost divided by 27 and a half years. And that portion of it, you could literally put down as a reduction of your profit for that year.
So one of the videos that we did last time, or little short snippets that we got on the last one, said a business is a great way to reduce your taxable income.
Yes, there's a lot of different things that happen in a business. All these different expenses that you incur in the business that you can deduct.
But when most people think of businesses, at least for me, and I don't know if I'm most people, but for me, I'm thinking like, oh, business, it's got to be like, you've got to have a brick and mortar. You've got to have like a real business, right? But what we're talking to you guys about right now is you don't have to have a profitable business. You don't even have to have a business that's like going. You might have something like last time we used the thing, I make flies for guys. We'll go with another one. Let's say you
maybe a mortician.
Mortician? You think we should go with that? That's a hobby? I'm thinking more of the hobby turned, how do I turn this into a business, right?
Right.
All right. Let's say you're a handyman and you kind of got an under the table business right now, right? There's a lot of handymans with under the table businesses. Would you agree?
I suspect so, yes.
It might not be true, but it could be true as well, right?
I suspect that it could exist.
Okay. So right now, your way of beating the IRS is under the table, right? Which you could get in big trouble for.
It's a bad idea.
So tax avoidance is not a crime.
Yeah, there's a difference between tax avoidance and tax evasion.
Okay, what's the difference?
Well, avoidance would be using the existing tax laws, taking all the available legal deductions that you can against your income that you make, reporting all of the income, and then taking the proper deductions. Whereas evasion could be, I don't think I'm going to report this income, and I'm not going to file it on my tax return, and I'm going to be willful about it.
Yeah, and maybe I'm going to ask you to pay me in cash, right?
Correct.
I'm going to take false deductions, right? Expenses that don't exist.
Right. That could be, most of the time evasion will relate more to the gross income, the income not being reported to begin with. Not as much nearly as the expenses. Expenses, they're just going to disallow when they don't have proper support for them.
Okay. I have not been audited since I've hired Mark. Thank you, Mark, for that.
You want to put that on a podcast?
Yeah, if we get audited, we could definitely
we'll deal with it.
No. If we get audited, and if the IRS was cool with it, we could definitely put it on a podcast.
We have receipts, we have supporting documentation, report all the income. So,
100%. I mean, we know that we're putting it out there right now. So if I get audited, I mean, I guess we would ask IRS auditor, would you come on the podcast with us, right? And we'll do it live to see what happens. But the most important thing that I learned through that audit was, one, everybody always brags about their accountant. I got the best accountant. I got the best accountant. I got the best accountant. And then, you get audited and you're like, I don't have the best accountant, right?
Yeah, you can't reach him. He's not available on the phone. Or I get a lot of that. I get people who come to me and they literally say, one of the reasons we're here is because we got audited and I tried to reach this guy after I got audited and he was nowhere to be found. I couldn't call him. He didn't answer his phone. He didn't answer his emails, text, nothing. I couldn't reach him. And then I got stressed out because I didn't know what to do. I needed to go to somebody else. And then they call me.
But the IRS is understanding about that stuff, right?
Well, not really. They're just that the time kind of keeps going on and the notices keep coming and then the hammer comes after that.
What does the hammer look like? What can the IRS do if you, let's talk about
like this. If you don't respond to a notice?
Yeah, let's say you screwed up and like I've had IRS notices where they've been like, you owe $283,000 and I've given it to you and you're like, oh dude, this is like, this is just an automated type of deal.
Correct.
So, but what if I don't respond and I just ignore it, what can the IRS do to me as a citizen, as a business owner? What are their powers?
Well, at the first stage, they'll go ahead and continue to issue notices that will heighten in concern. In other words, it'll say intent to levy or take money out of your account. Then they'll actually go and do something like that. But the first they'll do is they'll assess the tax. In other words, the first notice you get is just saying, hey, we believe you might owe this. They give you a number of months before they actually start to do an assessment. And then once they assess it, then it goes out for collection. And then when it goes out for collection, then it could just be a matter of months before they start to levy or take money out of your bank accounts to the extent of what they think you owe based on just this assessed letter.
What if I don't have a bank account with any money in it?
Well, then they could look to assets and your credit. In other words, they could look to try to put a lien on your credit, which means that'll prevent you from.
You could put a lien on something. So is that like when you garnish people's wages?
It's similar in the sense that it would prevent someone like yourself if you were trying to buy real estate. And let's say you were trying to get a loan, the bank would say, well, we can't really do anything because there's this lien on your credit, which means that.
So it's a lien against your social security number.
Basically, yeah. Because
I have never heard of that.
Yeah, it's a problem.
It's a problem. So, okay, let's take a deep dive down that.
Sure.
So I did not know that. So the IRS has the ability not only to levy and take money out of your bank account, not only to seize your properties and assets, but if you figured out to hide all that or whatever you did with that or sell all that, they can then put a lien against your social security.
Yeah, they basically do. What happens is they put a lien or notification on your credit so if you try to obtain credit in any way, then someone will say to you, we'll extend your credit, but you have to pay this obligation off first. So you'll be obligated to take care of that before you move forward on any deal. Here's another thing. People try to refinance their personal residences to take cash out to avoid those things. And in a refinance, the bank's going to say, guess what? We just found this on your credit. So we can't really do anything until you resolve this or you show proof you paid it, and then we can move forward with our transaction. Wow. So, yeah.
Is there anything else that they can do?
Well, I've seen them even garnish people's Social Security. They're literally like they're in the poorhouse and all they're getting is Social Security. Or the other thing I've seen is, they take it out of, any possible income you might get. Also for businesses, let's say you're doing business and you have money you're collecting from customers. Yeah. They can reach out to your customers, look online and see if they can get a listing of who your customers are as far as who, with your information, your prior IRS reported information. They can see who you have had as customers, and they can go out to them and say, this person has an obligation with us. If you owe them money, then you should be paying us first.
Wow. Have you seen that happen?
Yes, I have. I have seen it happen.
Wow.
Yeah.
What else can they do?
I mean, there's other things. They can put you in jail.
Okay. Yeah, that's where I was going. That's where I was going.
But the jail piece is usually, it's not a matter of the collection issue as much as it is willful non-reporting. That's the part that really, if you will, the non-professional term, chaps their hide. In other words, they don't want to have to deal with, someone non-reporting, because then it's a deep dive. They have to look at, well, okay, he didn't report this year. What else did he not report? And they might go back 7 years just to kind of see what's going on and also see patterns. They look at spending patterns. They send investigators to the people's homes and see how they're spending their money, if they live in a lavish lifestyle, if they drive expensive cars, if there's a lot of cash going in and out of bank accounts, that kind of thing. And that's why, and then they might do what I'm saying is they could potentially bring charges on the person for not having filed.
So there's a famous person who went to jail, several famous people who went to jail for not paying taxes. Can you name a few of them?
I think, and I don't know if I know one of them did time, but I think Wesley Snipes.
That's the one I was thinking of.
Willie Nelson's also, yeah.
So do you know what Wesley Snipes went to jail for?
Well, it was evasion.
How long did he go?
I don't know. It was probably 2 or 3 years or something like that.
They can send you to jail for not. Okay.
Yeah. So, and I don't know the exact term. You got to find it.
Yeah. So there's a lot of these people that believe When I say people, citizens of the United States that believes that taxation is theft.
Oh yeah, I have a client similar to that where the husband went to jail, and he literally, it was sad because during COVID he actually died because he wasn't given proper medical care. But at the same time he went to jail because he didn't file taxes, not even pay, just didn't file.
Right.
So
okay, going back to how the country was established. We were established because of taxation without representation from the British government, right?
yes.
And then we colonized out here in the good old USA, and there was no taxes.
For a period of time.
And then when did taxes begin?
I think it was 1913.
Was that when the Federal Reserve was formed?
I think around that same time.
Right. Interesting.
Yes.
Comment below if you have a theory about that. Yeah. So do you think that the IRS and the Federal Reserve work together?
You know, I don't really have an opinion on that, and I like my life the way it is.
Okay. Anyways, no, I'm just curious. Like, just
yeah, I would say that
because they started around the same time.
I don't know that they definitely related in that manner. I think that the Federal Reserve, it was just a way for the government to use private industry to figure out how they could continue to keep the economy where it was. I mean, we've had a national debt since 1776. So
we haven't had national debt since 1776.
Yes, since the beginning of our existence, and so that's why I'm saying.
Do you know anything about the national debt?
Currently, it's like 23 trillion or something.
But you know, like, what does that even mean? Like,
I think a majority of it is held by the citizens of the United States. In other words, money owed to them, and then there's a decent portion with China. But I mean, as far as whether our country's currency could ever be depegged or any of that kind of stuff, I have my doubts that would happen.
Right. Hey, if you're listening to this podcast right now, I hope you enjoyed. I hope you give us a 5-star review. And we've got content all over the place, TikTok, Instagram, you name it. But we also have a coaching program. If you are looking for a coach, we have the Millionaire Mentorship, and this is a coaching program where I actually help you get your first investment property within the first 90 days, or I'll pay you $1,000 cash. That's how confident I am to get you that type of result. And I know you might be here and you might be listening, you might be scared, you might not want to take action, but that is not going to get you where you want to be. And obviously, if you're listening to this podcast right now, you want to take action and you're trying to gather the information, but maybe you're confused. Maybe you're just like a lot of people that I talk to. You're scared of losing money. You want to become financially free, but you don't know where to start. And that's exactly what I help you to do in this program. So do yourself a favor, book a call with me and my team, and let's get the ball rolling. The link is in the description, and we'll put it in the video right here, right now. Thanks. Hope you enjoy the show. Working with thousands upon thousands upon thousands upon thousands of clients, what is the number one way that people get audited, or that they could avoid an audit?
Unreported income.
That's the number one way.
Yes.
What's the number two way?
Number two way. Okay. So there's basically over reporting of expenses relative to the income is another one.
Okay. So like if I say I spent, I made $1 million this year, but I spent $800,000 on meals and entertainment. That might be one that might get me.
It could be. I mean, everything's relative to the gross income, right? If you had $40 million worth of gross income, maybe $800,000 in meals might be reasonable. It just depends on how much time you spend taking people out and entertaining them, and how many people at each sitting. Because there could be a lot of people. You might do groups. You might do a lot of that. And so it's all relative to the gross income, what seems reasonable.
Yeah.
And, but yeah, that happens a lot.
Okay. Now let's ask a controversial question. You brought it up yesterday at our mastermind here, and you said Trump didn't pay taxes. And you said another thing, and I'm going to talk about both of them. So did Trump break the law?
No. He didn't. According to the way I see the taxes, he didn't break any laws. He used the tax laws to his advantage to report whatever income he had and losses that he had on businesses.
So the other question is, you mentioned yesterday that most people who complain about people who don't pay taxes, like people who are mad at Trump for not paying taxes, mad at Jeff Bezos for not paying taxes, mad at all these billionaires, millionaires, whatever it is, they are generally the people who don't pay taxes.
That's the ironic part. They pay Social Security and Medicare on their wages, but many of them are upset because, and it might be because of the social media influence, you know, that they're getting, but they don't really pay. Like, if you look at how much of the tax is paid by the wealthy in the country, it's like 90% of the tax is being paid by the wealthy.
So 90% of the tax
of the actual tax being paid in.
Yeah.
That's why, that's this ironic part about this. But when you also think about what a politician would do if he has to run for office, it was something I mentioned the other day. A politician has a platform he can run on, and he's not, with a lot of the country being on social assistance, he's not going to run on a platform or she that says, I'm going to cut social programs. I'm going to cut Social Security or Medicare or welfare, because then he won't get votes or she won't get votes. So then the other avenue is, what do? We're not going to increase taxes on the middle class because there's more votes gone. So then the only alternative, which has been the most recent mantra, is let's raise taxes on the wealthy.
Right. Even though they're already paying 90.
Right. They feel they're not paying their fair share of taxes. And that's based on what? I don't have any information associated with that.
Political. I think it's based on political.
Yes.
Like, they should be paying more because they're not paying.
And again, it's a way to get elected. That's
a way to get elected. Okay. So going back to our business question. So let's say that I have a lawn mowing business. It's not a handyman business. Forget the handyman business. It's a lawn mowing business. I couldn't get with the handyman thing.
Right.
So it's a lawn mowing business. It's I pressure wash, I lawn mow, but I'm doing it under the table, or I'm doing it as a sole proprietor. Where am I screwing up?
Well, a couple things. One is, I hope you are doing it as a sole proprietor and you're reporting the gross income.
I do too.
And then and then you're putting down all of the expenses that you incur for the business. Everything that's ordinary and necessary in the course of that business, you can deduct. That's the IRS's language associated with this. So you go ahead and do that. You report on Schedule C on your personal return. The downside of that is there's two things going on. You've got everything up to $168,000 is subject of net income. In other words, that's the profit minus all the expenses, the gross income minus all the expenses. So you're paying Social Security and Medicare on that, and income tax. So you're paying 15.3% Social Security and Medicare, and you're paying income tax on that money. Okay. So it's expensive. And the government has intentions.
As a sole proprietor.
As a sole proprietor, and you're also on the highest audited form on an individual tax return, because 90% of tax cheats that are out there cheat on Schedule C. So the IRS looks at that form more than any other.
How many percent?
Like 90%.
90% of tax cheats
cheat on that form.
Cheat on that form. Okay. So I meet with you. I'm like, hey, I'm running this business. It's a lawn care business. I've been taking some money in the table. I'm running as a sole proprietor, Mark. How do you get me set up so I can pay the least amount of taxes and take the most amount of deductions and scale my business? So
a couple of things. One is, we get you out of the mindset of taking stuff under the table. We got to get that off, and especially in this environment now where almost everybody's getting paid electronically with things. So we get you into that mode. Then the second thing is we look at how much income are you generating from this after expense. Then we look at, number one, maybe we set up a different structure for you. Maybe we get you into an LLC, and then we look at the possibility of you electing what's called S corporation status. Right. And then you get onto this different form. You are able to save some tax in the process, still reporting your gross income the way it should be, and taking all the available deductions that you can, but saving income tax. And
how much income tax?
Well, it could be significant because what you're doing is you're going to pay yourself a reasonable salary for the services you're providing to the company. And then all the other income over and above that will not be subject to Social Security and Medicare tax.
All right, so let's break that down. So what he's saying is basically, let's say it's my landscaping business. I'm pulling in $200,000 a year gross, and I pay myself a $50,000 salary.
Right, depending on what the net income is. The expenses, let's say if the expenses are 100, okay, now our net profit is 100, and you pay yourself a $50,000 salary. Okay. Now you got $50,000 that's not subject to Social Security and Medicare tax. You're saving $7,650 in taxes.
How much?
$7,650 in taxes.
Okay, so now, is that as an LLC? Okay. So
an LLC taxed as an S Corp. The LLC alone won't give it to you. You got to be electing S Corp status, and then you're filing as an S corporation.
So what's the difference between an S Corp and a C Corp? You hear a lot of people talk about you should do, like a lot of the big stocks are C Corps, right?
Sure.
So why do you suggest for me as a real estate investor that I elect a S Corp?
The main reason is you're a service business, and so your inclination is not to leave all of your cash in the business for operating. It's to take it out and invest in different things to grow your wealth. So you're better off being in an S corporation where when you take the money out, it's simply what's called a non-dividend distribution. It's not subject to additional tax. You're taxed on the net income of the business itself. Like if in that case, the lawn mowing business, net income was, let's say, 100,000 minus the 50,000 salary. So you'd have 50,000 of net income. So that flows through to your personal return where you're taxed on that, as well as the W-2 you got from the business. That's the other 50. And you're going to be taxed to that. So if you're in a C Corp, C Corps are great businesses for businesses that are capital intensive. You got to keep all the money or a lot of the money in the business, and they have a flat tax of 21%. But in order to get the money out of a C Corp, you've got to either take a dividend, which is then not deductible by the C Corp and taxable to you personally. So you're paying, and taxable on the personal side could be anywhere between 15 and 20%. And then on the business side, you're still paying 21% on that same money. So you're paying a lot of money, 36, 40% on that money. It doesn't make any sense. And I mean, you could choose to take a salary out of there, but then what you're doing is you're using your salary to draw all the net income to zero. And then over on the personal side, you could be in the 37% bracket, and you're paying 37%, plus you're paying 15.3% on the Social Security and Medicare. It's like, that's a lot of money.
Yeah. So there's a guy, I'm not sure if you're familiar with this. Have you heard of Peter Thiel?
Yes.
Did you hear what he did?
Not recently.
Do you hear how he's avoided taxes?
No, that's what I'm saying.
So what he's done is he's done all of his investments under it's a tax exempt retirement fund account.
Oh, okay.
Okay. And so, and he's like one of the richest guys out there. He owns like Facebook and stuff. And so he literally bought everything with, God, what are the tax vehicles for like retirement?
You're talking about IRAs or Roths or...
Yeah, something like that. I don't know if it was that exact thing. What other type of retirement vehicles are there?
Well, you could have defined benefit plans that he might be using.
Okay.
It just depends on whether it's tax deferred or whether it's like in the case of a Roth, you're basically paying your tax now, and then later you don't pay no tax on the earnings of it.
All right, so let's break down the 401ks, the IRAs, the Roths, all that. Let's get into that. So 401k... what's that all about? Why do I want one of those, and why do I not want one of those?
Well, okay, so you're putting your money into a vehicle where it could be tax deferred, and you could essentially not pay tax until on that money until you decide to take it out at age of retirement. But then the money's tied up in whatever it is that's there. And if it's earning great returns, that's great. If it's not earning great returns, then not so great.
Right.
So that's the issue, is a lot of money can get tied up in that. And if you've got institutional people with institutional money and they're it's being invested by machines or by people who aren't really watching what's going on, then you could lose a lot of money in the market, and maybe you don't have that much control, in other words, over what's going on with your investment. So that's one thing. But it does present a tax deduction in the current period and a way for you not to pay taxes for a long period of time. Just hope that there's enough money there when you retire that you can use that, right?
Yeah.
So then there's a lot of people, believe in the Roth IRA, and that is where you can put money in, and then later their philosophy is that the government will continue to increase taxes. And I believe that to be the case in the future. I don't know what else, what their other solution is going to be to that unless they create a lot more taxpayers. In other words, by creating a lot more production in the country where people are paying taxes, then they won't have to do that. They won't have to increase taxes on everybody.
So you've been doing taxes for how many years?
30.
30 years. Where have you seen it go and where is it going?
Well, basically, what I'm seeing is that they're continuing to find ways to increase taxes on people in general, whether it's Social Security taxes, regular income taxes, and then also now we've got the insidious tax, which is inflation. So we're not even tracking that one. And when you look at that whole dynamic, you got people who are putting money into these retirement accounts thinking later my expenses will be lower because, I'll be retired and maybe all my debts will be paid off. I won't have as many payments. But then the problem with that is with inflation, they're going to be taking out just as much, if not more, that they're utilizing now to pay for their existence. Bread's going to go from whatever it is, $3 a loaf to $30 a loaf. It just depends on what the cost is. And because of that, they're going to be taking it out and they're going to be paying tax in those future years. So that's why it's not always necessarily the best vehicle to look at. I have people, use deferred or defined benefit plans to do the same thing. And again, it all depends on what you're doing with the money that you're going to put in the plans, because some people can invest in real estate, some people can invest in in securities. It just depends on what you're going to do and how much control you have over that money. That's the issue.
As a CPA and as a real estate investor and as a businessman, who besides these guys who build these great businesses, because we know that that's the best, you can make the most money in business, but that's harder to do, right?
Sure.
Like there's more businesses that fail than anything else. But real estate is a business, okay? And it doesn't fail. And there's a lot of laws that are advantageous to real estate investors.
Yes.
One of them is called, you get a certain designation with the IRS. What is that designation with the IRS?
So if you're in the business of real estate, you're actively participating, you're spending a certain number of hours per year in material trades and activities associated with real estate, you can take a designation called real estate professional status. There are a lot of conditions associated with doing it, but if you do, it allows you to take the full extent of the losses associated with your real estate activities and against all of your other active income. So that's a big deal, especially because of depreciation laws.
Can you break down active income versus passive income? So it confused the shit out of me when I first started. People talk about it like that way. You think, oh, active income, I'm actively making income. Passive income, I'm passively making income.
Sure.
But it's not what it is. So
Right.
can you break it down?
Right. So someone who, let's say, I'll give an example. Let's say there's a doctor, okay? He's spending his waking hours working on his practice. He's taking care of patients, and he's dealing with all of those dynamics of his medical practice. He's not spending, and let's say he owns a building, he's not spending time on managing and taking care of his building, and he hires other people to handle that. So it's essentially like a passive activity for him. He's not actively involved in all of that. So that's the distinction. And many years ago, back in the 80s, the government looked at this and said, we're not going to let people just take deductions for these type of activities. We're going to separate and create this passive and active status. And we're going to say, if you have passive status, then you can only take these deductions to the extent that you bring the income to zero. and then afterwards you have to suspend these losses or these additional expenses to a future year where you can utilize them against the same income to reduce it to zero. Or in the final year, when you sell the property, you can take it against as ordinary income against that property.
Can I simplify that?
Yeah.
Okay, because that was really complicated.
Yeah. So simplify would be passive. Person who's passive would be not really involved in the day-to-day activities of that activity.
Yeah.
Okay. And then someone who's actively would definitely be someone who's like a real estate professional would be involved in day-to-day rehab of properties or supervising people who are doing rehab of the properties, calling real estate agents, dealing with agents.
Are they taxed differently?
Well, yes, because what happens is with a real estate professional, again, they can take these losses completely in the current year against any other income. Like let's say they have real estate sales, okay, where they
That's active.
Yes, that's active, and they're generating ordinary income. They have, let's say over here, they have $500,000 from real estate sales, and then they have 20 properties that they own, and all of these properties they're actively participating in, and so they elect real estate professional status. And let's say the net effect, because of depreciation and other things like the rehabbing the properties, is literally causing them to have a loss of $100,000. They can take that $100,000 against that $500,000.
Awesome. Okay, 2 last questions to finish up. When is the deadline for filing taxes, and what are the consequences of filing late?
So the normal deadline for filing business returns is March 15th.
Okay.
You can file an extension to take you to September 15th. Afterwards, then there's penalties for S corps and partnerships that are basically per month, per partner, and can get expensive. And then there's C corps. They're due April 15th, and their extension is till October 15th. Then you have individuals that are April 15th is their deadline, and they're extended to October 15th. And if you don't pay your bill, let's say you can extend the tax return to October 15th, but if you don't pay your bill on April 15th, you're going to be looking at 6% for failure to pay penalty, as well as 8% interest on the money. So very expensive after April 15th.
What can I do if I can't afford to pay my taxes by that deadline?
You could enter into an installment agreement once you do file the return. Mm-hmm. You could get on a call with the IRS once you file the return and request an 180-day extension of time to pay, and they might grant that to you. You could do stuff like that.
Final question before we let you go. Let's say I hired some bum, the first person that I hired before I hired you, and they put me in a bad situation. You come to me, will you deal with my problems? Like, let's say I'm getting audited right now. I'm just stressed out. The IRS is knocking at my door. What's the first step that you're going to make to get me out of this trouble that I'm in and give me some peace of mind?
The first thing I would do is I'd probably take a look at the situation. If we have the ability right then to do what's called audit reconsideration, I would reach out to the IRS and look at putting a collection hold on your account so that we could reevaluate all of the documents that you have and put together a package for reconsideration, because it's possible that there's information that wasn't included in the first submission.
So what you're saying basically is people that don't know how to submit, accountants that don't know how to submit things the right way might not have done something. And if you take your trained eye to it, you might just need to amend the return and stuff could go all the way away.
It's possible.
Has that happened?
Yes, it has happened, because there's been expenses that people haven't realized that they had, that they didn't take deductions for. And also other things too. The IRS assesses certain penalties. If that person's a good tax-paying filer, they file timely, they pay timely most of the time, then it's possible that certain penalties can get waived, but they have to be asked. If you don't ask, you don't get.
Awesome. Mark, how can people get a hold of you if they want to consult with you, if they want to get a hold of you? How do they follow you on social? How do they get a hold of your office? Drop it right now.
Yeah, 702-645-6318 is our office number. You can reach Tiffany Mitchell. She's our Director of Client Relations.
Okay.
And then she can introduce you to the firm and tell you all about us and tell you what services we provide and how we can help you.
How do we follow you on social?
I think we're on Instagram. That's not my.
We'll link to it, guys.
Yeah. Sorry.
Don't ask Mark for social media questions, but he's a.
I'm working on it. I'm working on it,
mate.
Yeah, I'm working. Remember that.
All right, man. Have you ever wanted to start investing in real estate, but you just don't have the time? You don't have the ability to get started, but you got the capital, right? And you want all of the advantages that the capital offers you. Well, I started a fund, and you can invest with me and my team. In fact, I'm in one of the buildings that I bought using my own money, but you could invest and actually get the benefits of investing with me and my team. Well, you got to be an accredited investor, and you've got to go to our website. I'll include the link in our bio, and you could start investing with us. It's super cool. We're going to do a lot of cool projects in Kansas City and around the country, and you'll be able to be a part of it. Make sure you give this podcast a 5-star review, share it with a friend, and take action.